Hello, my name is Don Miller and I've been a professional trader and educator of the futures and equities markets for the past 10 years. I'm very pleased to be joining Pivot Point Advisors and bring many of the tools and techniques that professional traders use to the management of long-term portfolios. Today I'm going to share with you some of the tools and techniques that we use to monitor the market and gauge market opportunity. So let's get started. Let's start with a simple bar chart. What you see here is a visual representation of price action of the S&P 500 between the spring and fall of 2010. It's a daily chart, so each bar represents the price action for that given day. Now, looking at this by itself, it doesn't mean a whole lot. Lots of lines, a lot of white space, not really much to make any sense of. But let's clarify the picture a bit. We'll begin by adding an indicator called stochastics. Stochastics are represented by those blue and red lines at the bottom of the chart. They help gauge market momentum and indicate market strength or weakness as the market gets stretched in one direction or the other. By themselves, they can be pretty helpful, but we need more. That's a bit better. We've now added moving averages. Moving averages reflect the average price, in this case of the S&P 500, on a daily basis over a certain number of periods. In this case, the red line reflects the last 15 days, and the blue line reflects the average price over the past 50 days. Combined with stochastics, they can be very powerful. So what does this all mean? Markets, of course, are constantly moving, and to many individuals, the markets remain a puzzle. Fortunately, professional traders have the advantage of seeing what the picture on the puzzle box looks like, and so we can begin to put the pieces together. For example, starting on the left, I've highlighted a series of price action points, which we can make some sense out of. You'll notice that I've highlighted three areas where the moving average lines cross each other. A moving average cross can be a very powerful indication or confirmation of the beginning of a trend move. In two cases, the green circles, you see where the market has extended to the upside from those points of entry. Conversely, in May of 2010, there was a very powerful bear signal that indicated that being in a long position would not be a smart move. But even before these points in time, the market was providing clear clues that a turn might be imminent. For example, in mid-April of 2010, the market was making a higher high, but its stochastic momentum indicator was making a lower high, a clear warning signal that a turn might be imminent. Similarly, the market provided other clues that likely price action was to follow. For example, the green line at the bottom of the chart reflects what we refer to as an inverse head and shoulders pattern. Picture, if you will, a man or woman standing on his or her head. You've got two shoulders on either side and a head in the middle. In this case, the market made a low, weakened further to make an even lower low, and then after regaining some strength, when it proceeded to try to make a lower low, it couldn't. A clear indication that the selling was likely drying up. In that case, the path of least resistance takes over, and if it's not going down, it can only do one thing. In this case, we had two additional clues. First, on the right shoulder, we had a point of market indecision. That's represented by the very short bar highlighted in green. At that point, the market has to break one way or the other. The break to the upside confirmed that the right shoulder was in, and a move to the upside was likely. On top of that, we had our moving average cross once again, which provided further confirmation of the likely move. Now you may be asking, this is all well and good, but what does it have to do with trading or managing my portfolio? Well, on the left, I've added another chart that professional traders often use to manage positions. It's called a three-line break chart. Essentially, it's a visual representation of the same price action that we see on the bar charts, just shown differently. In this case, once that turn first occurred, it provides us a good indication on whether that trend remains intact or not. One of the goals in trading or managing portfolios is to make sure that gains are not lost. Trailing stops are often employed, which basically means if that market drops below a point at which we're comfortable or below a point at which we believe the trend will still continue, there's no reason to be in that position, and we will exit. Here's a chart of the S&P 500 on a weekly basis. This reflects the price action between mid-2007 and late 2010. Here you'll see many of the same signals that we saw in the daily chart, from moving average crosses to price versus stochastic divergences. That's because it really doesn't matter what time frame one looks at. These triggers and signals and bias indicators work on any time frame, whether it's a professional trader who uses it on a 5 or 15-minute intraday chart, or whether it's an effective portfolio manager that uses it on a longer time frame. In fact, it's often most effective to combine time frames. Here we still have the weekly chart on the right, but I've inserted the 3-line break charts on both the daily and weekly time frames on the left. It's often helpful to use a lesser time frame as a trigger. As I often tell people, a market can't start going up a lot until it starts going up a little. By using the daily as a turn signal guide and a weekly as a larger backdrop, effectively combining the two time frames can provide for better management than if one simply focused on one. Now, it's important to note that technical analysis, while very effective, is not a magic bullet. Nobody can predict the future, and anyone who tells you they can, well, my advice would be run. But technical analysis can be helpful in terms of determining the probability of moves, the market bias, if you will, because it's our job at Pivot Point to get you into the market at the right times and keeping you out of the market at the wrong times. To that extent, technical analysis can be a very helpful guide. I thank you for watching this. I hope you found it helpful, and I look forward to working with you.